Hello everyone, today we are going to be talking about dividends. Super important topic. I'm very passionate about it, so let's jump right into it. First of all, a dividend is defined as a portion of a company's profits that the company decides to pay out to their shareholders. Dividends are optional. Companies aren't required to pay out any sort of dividends. A lot of the bigger companies do, but especially with smaller companies, a lot you will not find paying out any dividends at all. To start out with a quick equation that is used very often in dividends, it's going to be the dividend yield. So this is going to be the dividend payment per share over the stock price, divided by the stock price, and that is going to be an annual rate. So there are two main types of dividends, cash dividends and stock dividends. Cash dividends are much more common, and they're basically, as implied, they're going to be the cash paid out in the form of money, and then stock dividends are going to be actual fractional shares of stock that some companies decide to pay out. Like I said, it's a lot less common, but yeah, stock dividends are still there. So let's get into some different payment frequencies. So this is the annualized or biannualized payment frequencies that some companies will pay their dividends. Usually it's just either going to be annually, biannually, quarterly, or monthly. And there are actually some weekly stocks that do pay every single week. I found two of them. WKLY is the ticker for one of them. TGIF is the ticker for the other one. As you probably can guess, this one is paid Friday. But these are both ETFs. These aren't specific companies, so they do have expense ratios, and I don't necessarily recommend investing in those. I don't know a whole lot about them. I think their expense ratios are kind of high. But yeah, I would have to do more research to actually give a definitive answer on that. But getting to this graphic here, between these, so basically these four items are going to be kind of what the company who pays dividends kind of has to go through to distribute them, to decide them, all that sort of stuff. So getting into the first one here is going to be the declaration date. And then this is the date of which the company decides on the amount of the dividend. This is when they tell the public how much each share of stock is going to be distributed with a dividend, how much that dividend is going to be. Moving on to the ex-dividend date. This is the day of which anytime before this date, the buyer of the stock will be able to obtain the dividend for this period. But if the stock is purchased on this ex-dividend date or after it, the buyer of that stock will not have rights to get that dividend. Instead, it would be the seller who would have rights to get that dividend. And then we go over to the record date. The record date is always going to be one business day after the ex-dividend date. The record date is just officially the day that the buyer of the stock, so the owner of that stock, will be allowed the right to obtain the dividend for that period. If the owner owns the stock on that record date, then they have the rights to that dividend. Lastly, it's the payable date, and this is the date of which you actually are paid the dividend, and that's what the company decides. So a brief example, these are arbitrary numbers, but for the declaration date, an example is the declaration date is August 1st. Since it's July 31st, I figured we'll just use next month as an example. So declaration date, August 1st, the company decides, let's say 50 cents per share is going to be their dividend. So moving on to the ex-dividend date, I had 8/15. So August 15th is the ex-dividend date. So if a investor wants to have the stock and they want the dividend for this period, the investor would have to buy before 8/15. So if they want, they can buy on August 14th. Then they would have the rights to that dividend for this period. But if it's 8/15 or after, anytime on or after this ex-dividend date, the buyer would not be able to have the rights to this dividend. So let's say the investor buys 8/14. So they do have rights to this dividend. Then we go to the record date. So that'd be 8/16, August 16th. If the individual bought the 14th of August, then 2 days after that is the record date. So the reason that the record date is 1 day after the ex-dividend date is because it takes 2 business days for a transaction to settle. In other words, if a investor buys a stock 1 day, 2 days later, it will be official. It will have settled into their account, and they will now be the new owners. So that's why this record date is the official day that the investor will be able to say they own the share, they can provide proof, and they will have complete rights to the dividend of that period. And then 8/25 is the payable date. So that's the actual day that this person would receive the dividend. So moving on to qualified versus unqualified, otherwise known as ordinary dividends. So I put a little smiley face next to qualified because qualified, the only difference between qualified and unqualified are the tax advantages. So qualified does have tax advantages. Unqualified is a lot less friendly in terms of taxes. So for qualified, these whole charts are based off 2021 single taxpayer data. So for this, I had taxable income on the top here and then dividend tax rate on the bottom. So for taxable income, if we're talking about qualified dividends, if you make between $0 and $40,000 of taxable income, so just regular income, you don't pay any taxes on the dividends for qualified. And I should say that qualified dividends are much more common. Most U.S. stocks are going to be qualified. So most of the time when you buy any U.S. stock with dividends, it is going to be qualified. So you will fall within this bracket. $40,000 to $446,000. If you make that much, 15% of the dividends that you receive have to be paid in taxes. Then $446K or over is going to be 20%. And then unqualified is kind of a similar breakdown, but there are a lot more buckets. I actually skipped a few buckets because I think there were like 7 in total. So for 0 and 10K, and this is a progressive tax rate. This is actually the exact same tax rate as the 2021 single taxpayer ordinary income tax. So it's the same exact percentages and the buckets, and it's a progressive tax rate. So any income between 0 and 10,000, you have to pay 10% of your unqualified dividends that they go to taxes. So like I said, this isn't used much more, but you can kind of follow along the rest of the chart if you want to see how much of the unqualified dividends would go into those brackets. But most of the time, you're just going to be focused on qualified if you live in the U.S. and you buy U.S. stocks. Lastly, I wanted to get into some dividend aristocrats. So basically what dividend aristocrats are is they're companies with large companies, S&P 500 companies, and there are 65 total dividend aristocrat companies. And these are companies that are defined as having 25 years or more of consecutive dividend growth. So every single year for the last 25 years or more, these 65 companies in the dividend aristocrat category have increased their dividends without once decreasing their dividends or dropping their dividends, anything like that. And then I specified 4 of the top 65 dividend aristocrats and then put them here. So we have XOM, which is ExxonMobil, and it has a dividend yield of 5.71%. This is Chevron, CVX as a ticker, and that has 4.92%. T is AT&T with 6.49% dividend yield. And lastly, we have IBM, 4.52. So AT&T does take the win, and it has the highest dividend yield of all dividend aristocrats. And just to put this into perspective, this is 6.49. So if you invest $100 into AT&T, you get 6.49 back every year. So it doesn't sound like a lot, but once you compound that over and over and invest more and more money, especially if you reinvest those dividends, then it really does add up, especially year after year after year. So it doesn't sound like a lot if you get $6.49 a year from an $100 investment, but it's just the compound rate over time, which really just helps you propel your investment portfolio. I want to end the video with a few pros and cons of dividends. So one of the main pros that I liked is passive income for dividends. So you don't have to do anything. You buy stocks with dividends, and that's it. You just hold the stocks, you get dividends, whatever frequency they pay out. So usually it's going to be quarterly or monthly from what I've noticed, sometimes biannually, but usually not annually. A lot of them are quarterly or monthly that I buy. So you just buy the stocks month after month. You get these dividend payouts, which are really nice, and you don't have to do anything. It's completely passive. So that's one of the main pros I like. Another one is going to be less risk. So dividends are going to be guaranteed income, and it's guaranteed in the sense that once you get the dividend, you have that money. It's in your brokerage account. You can go to an ATM, deduct it, spend it on whatever you want, buy an ice cream cone. It doesn't matter. That money is yours. But for something like a stock that doesn't have any dividends at all, and you're just buying that stock for capital appreciation, it could go bankrupt in a year. It could go bankrupt in 2 years. You're not guaranteed any money from that. So for dividends, it is less risky in the sense that you are guaranteed that money once you at least get one dividend. And then year after year, as the dividends rack up, you get all that money. So it's less risk in that sense. And then another good thing about dividends is the dividend reinvestment. So it's called DRIP. It's dividend reinvestment plans. A lot of brokerages have them for free, such as Robinhood. I know Webull currently doesn't. They're looking into getting that. But Robinhood, what basically dividend reinvestment is anytime a company pays a dividend, the brokerage like Robinhood would automatically reinvest that dividend back into the stock at the market price. So basically, if you didn't need that cash and you just wanted to keep compounding your portfolio based on your dividends, everything is done automatically, and the Robinhood will automatically convert all cash dividends back into buying fractional shares of that stock every single time a dividend is paid into your account. All Robinhood does is they just send you a message saying your dividend of, let's say, $1.50 for AT&T was reinvested back into the stock, and you now have a little bit more shares of AT&T than you did previously. And that's what dividend reinvestment is. So that is super nice to have, because with capital appreciation with stocks that don't have any dividends paid out, you'll just have the same amount of shares every time unless you buy more with your own money. But with dividend reinvestment, you don't have to pay any more money. You'll just keep getting shares based on the dividends that you receive, because you'll automatically be buying more shares with every dividend that comes out. The main pro I had, last main one was it is an inflation hedge due to dividend increases. So it is an inflation hedge in the sense that usually companies will increase their dividends at a quicker rate than inflation increases. So basically you will be beating inflation with a lot of the dividend stocks that you own. So that is a hedge against inflation. And I did want to end the video with a few cons, because although I did talk about a lot of the good things with dividends in this video, there are definitely some cons that do need to be addressed. First con I had was less stock price appreciation for dividend paying stocks. And this is mainly due to the fact that with dividend paying stocks, companies pay dividends based on their profits. So when companies have profits at the end of the year and they pay out dividends, they can't use that money to reinvest in the business, to go into retained earnings, to do future projects. Since that's paid out to shareholders, they no longer have that money to build their business more than they would have, essentially. But with something that a company, especially in a growth stage, that doesn't pay any dividends, instead of using that money to pay their shareholders, they can, partake in new projects, invest in new business ventures, stuff like that. And dividend paying stocks are kind of limited in that sense, because they don't have that extra money, since they do have to pay out for shareholders. So that could be one con of dividends. Another one is kind of goes along with that, is less money reinvested back into the business. So with less money reinvested back into the business, you ultimately want the share price to increase after you buy it. So with less money being reinvested back into the business, the less of a chance it is the price will increase for a stock. And that's specifically why a lot of the dividend paying stocks don't increase as much as non-dividend paying stocks. Okay, another con is going to be the taxation of dividends. So dividends are kind of double taxed. So they're taxed at the corporate level in terms of after a company makes all its profits for the year, they get taxed on those profits, right? And then they're able to distribute these profits, some of the profits, down to shareholders as dividends. And like I said, with qualified and unqualified dividends, we have to pay some of the taxes on these dividends. So they're taxed at the corporate level initially after the profits are made, and then they're taxed at the individual investor level. So they're really taxed twice, which is pretty unfortunate, but that's just a part of the taxation laws. But yeah, I think that just about clears all of the basic information about dividends. If you guys have any questions, leave them in the comments below. I'll do my best to answer them. There's so much to talk about with dividends. I really just scratched the surface. I try to get all the basic fundamentals down about dividends. Obviously, there was so much more I could talk about, but I didn't want this video to go on forever. So if you have any comments, let me know, and thanks for watching.